This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Good afternoon, everybody. Live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're streaming on YouTube as well. I'm Tim Stenovec, along with, wait a second, that's not Carol Massar. Bloomberg News cross-asset reporter Isabelle Lee is in for Carol Massar on this Friday. And Isabelle, you chose quite a day to come in with equities under pressure. We're seeing sort of the worst streak of weekly losses for the S&P 500 since 2022. Cross-asset, it's not looking pretty.
It's not looking pretty, and you forgot to mention the Nasdaq, which is officially entered the correction territory. Brent crude up by around 111 per barrel, and the VIX hovering at around 29. It's an exciting day, Tim.
It is. And you know, all of it emanating from the Middle East. Strikes from both sides continue after President Trump's deadline extension. And that is the backdrop for our program this afternoon. We're going to have the latest on the Iran war from Washington and the signals that the president is sending to the Middle East. On that, an expert in Iranian drones and nuclear facilities, Spencer Faragasso, joining us to discuss the prospect and practicality of a denuclearized Iran. Also, the conflict sending borrowing costs higher. Kathy Jones is stopping by from Charles Schwab on the outlook for bonds and the bond market. All that and more coming up over the next hour right here on Bloomberg Businessweek Daily. First up, though, on that trade and the pressure that stocks are seeing, Charlie Pellet is in the Bloomberg Businessweek studio. Hey, Charlie.
All right. Thank you very much, Tim and Isabel. Lows of the day right now on the S&P 500 index, a familiar phrase that I've been using for several updates today. Right now, we've got the S&P down 90 at 63.86. So the S&P now falling below 6,400. Right now, looking at a drop of 1.4%. The Dow also down 1.4%, tumbling 667 points. S&P, by the way, on track for its fifth week of losses. Nasdaq down 417. The Nasdaq Composite Index down now by 2%. And as you mentioned, correction for the Nasdaq 100 Index down now by 1.7%. That defined as a drop of 10% from a recent high. 10-year, 4.42%. The VIX above 30. The 2-year yield, 3.90%. Gold is up $119 the ounce, up 2.7%. $44.95 for an ounce of gold. West Texas Intermediate crude, $98.50 for a barrel, up 4.3%. Brent now above $112 a barrel. Brent up by 3.9%. Oil majors also gaining as crude moves higher. ExxonMobil up 3.1%. Chevron up 1.9%. ConocoPhillips up by 0.7%. So again, recapping the Dow, the S&P, Nasdaq all very much in the red. S&P down 1.4%. West Texas Intermediate crude, $98.71 a barrel. That, Isabel and Tim, is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Now to the latest out of the Middle East, and to our live blog we go, where it's reporting that strikes from both sides continue after President Trump's deadline extension. The U.S. and Israel hit nuclear and steel facilities in Iran. Tehran threatened retaliation against steel plants, and stocks are lower as Brent crude is higher, hovering around to $112 a barrel. The Strait of Hormuz remained largely closed to shipping. I want to bring in Iain Marlow, Bloomberg News national security editor. He joins us from our Washington, D.C. bureau. Iain, I want to go back to what we heard yesterday after the market closed from President Trump, pausing the period of energy plant destruction by 10 days to Monday, April 6, 2026, 8 p.m. Eastern time. The markets, we saw oil fall on that. We saw futures move higher on that news. And then fast forward to today, and it seems like things are not cooling down at all in the Middle East. What's with the mixed messages, the mixed signals?
Yeah, I think they seem to be pretty closely related in the sense that anytime stocks fall too much, oil prices rise too much, you hear signals from the Trump administration that talks are going well, negotiations are happening, the war is not going to last very long. And then you see market reactions. At the same time, we know that the market is anxious about unclear U.S. strategic goals in this conflict. There's not a lot of things the U.S. can accomplish short of opening the Strait of Hormuz now that would have a significant long-term impact. And so at the moment, there's no clear rationale or endpoint for the war short of Iran just acceding to U.S. demands. And the 15-point plan that we've seen put forward by the U.S. seems to have a lot of the demands in it that Iran rejected in the talks leading up to the U.S. and Israeli strikes that opened this war. So it's, we've seen a sort of very obvious interplay between, Trump's comments, administration comments, and, oil and stock moves in the sense of just, Trump trying to calm markets, essentially. And we've got a lot of mixed messages from different officials in the administration and from Trump himself, sometimes in the same day. So there's a lot of confusion and not a very clear end state in terms of where we get to, with this conflict right now.
So is the U.S. actually signaling flexibility here when it comes to enrichment and sanctions? And from Iran's perspective, why the hesitation to come back to the table?
Yeah, I think in the 15-point plan the U.S. put forward, there's all sorts of things that basically go against what Iran has been doing for the last 40 or 50 years, not supporting militant groups across the Middle East, curtailing its nuclear program, curtailing its ballistic missile programs. All of these things are things that they have slowly built up over time, to give themselves a security posture that they feel comfortable with. Obviously, the U.S. and the West don't want Iran to be doing any of these things, but as we've seen from previous U.S. administrations, this is a tough thing to get Iran to agree to. We've seen things from former U.S. officials saying Iran is a problem to be managed, not necessarily a problem to be solved. And the issue here was the U.S. going into those talks ahead of the war, with these extremely maximalist positions, asking Iran to basically give up everything to get nothing, essentially. And, Trump was the one who pulled out of the Iran deal that the U.S. struck with Iran before, and has bombed Iran twice now in the middle of talks. So you can see from Tehran's perspective that, they don't necessarily see the U.S. as a trustworthy negotiating partner, and vice versa, given all of the Iranian attacks on U.S. troops and personnel over the last few decades. So there's a lot of ill will, and right now, one of the key aims of the war seems to be to open the Strait of Hormuz, which was something that did not exist. It was a problem that didn't exist before the war began. So we're in very strange strategic territory right now, where the U.S. is asking for stuff it had wanted in talks that it themselves abandoned in order to start a war, which then created more problems, which the U.S. is now trying to address with talks. So it's a bit of a confusing situation for a lot of us following this on a day-to-day basis, and you can see the markets just sort of gyrating back and forth here with every utterance from the White House, which may indicate either it's escalating or talks are going well.
Well, Iain, on the view from Tehran, I want to bring up a post on X from Abbas Araghchi, Iran's foreign minister, who writes, just in the last few minutes, Israel has hit two of Iran's largest steel factories, a power plant, and civilian nuclear sites, among other infrastructure. Israel claims it acted in coordination with the U.S. The attack contradicts the president's extended deadline for diplomacy. Iran will exact heavy price for Israeli crimes. Does this contradict that extended deadline for diplomacy that we heard from the president yesterday, these attacks on infrastructure?
Yeah, it's not clear. I mean, obviously, essentially any attack on any civilian infrastructure in wartime is essentially a war crime. And the deadline that Trump mentioned was specifically related to power plants, presumably that the U.S. themselves wanted to hit. This is not necessarily the first time we've seen U.S. and Israeli war aims diverge. That's been an issue from the very beginning of this conflict. But you're right in the sense that the U.S. and Israel are in this together. Iran sees them as linked. They are only engaging at the moment with the U.S. side seemingly on talks. And the commentary out of Israel from Benjamin Netanyahu and others is that this war is very much continuing. They have their own goals in Iran that are different from the U.S. And so this is not the first time this has come up as a problem. And if Iran is seeing it that way, it could be an issue for this deadline and the sort of the talks. Although again, this deadline is a bit amorphous in the sense that it keeps getting extended. As Trump kind of seeks off ramps here to a conflict that is just totally rocking markets. Israel has come out and said that they did hit some of these nuclear facilities, but their justification for that was that these were plutonium sort of enrichment related facilities, not civilian nuclear facilities. They were designed for weapons grade material.
Very quickly here, we're hearing the 15 points versus 5 asks. Is there actually any real overlap to work with?
I think there are things on both of those lists that we know are red lines for both sides. I cannot imagine, for instance, U.S. taxpayers or Israeli taxpayers supporting war reparations for Iran to help rebuild some of Iran's facilities, for instance. That's one of the Iranian asks, as is sovereignty over the Strait of Hormuz, which it didn't have before the war. So, there's no way the U.S. is going to agree to those. And so that's why, to some degree, you're seeing this escalation, this intensifying of the conflict, even as we see, Trump repeatedly saying he wants a ceasefire. I think the reality here is that we're not in traditional peace talks. We are in talks between two extremely hostile, long-term geopolitical enemies, and even as part of the ceasefire deal that Trump is trying to push, there are massive asks in there for Tehran, and so there is basically no way Iran will agree to this unless in the U.S. mind, unless pressure is brought militarily. Okay. So that's the kind of issue we're dealing with right now.
Iain Marlow, really appreciate you joining us. Iain is national security editor for Bloomberg News, joining us from our Washington, D.C. bureau. I want to drill down on some of those nuclear headlines that we saw. The Kandab heavy water research reactor targeted twice by U.S.-Israeli airstrikes. That's according to the semi-official Fars news agency. And Iran said its yellow cake production plant in Ardakan Yazd province was targeted by U.S.-Israeli strikes on Friday afternoon. That's according to state-run Nour News, who cited the Atomic Energy Organization of Iran. For more on this, we're bringing Spencer Faragasso, senior fellow at the Institute for Science and International Security. He specializes in Russian, Iranian advanced conventional drone systems and nuclear facilities in Iran and North Korea. Spencer joining us from Washington, D.C. Spencer, I want to start with those two headlines. And you specialize in looking at satellite imagery, understanding the extent of damage from attacks and what's actually happening at these facilities. I know it's still early days, early hours at this point, but what can you tell us about the yellow cake production plant in Yazd province and the Kandab heavy water research reactor that was targeted twice, at least according to semi-official news agencies?
Yeah, well, first off, thank you for having me on the show. Really appreciate it. So the Kandab research reactor, it's also known as the Iraq IR-40 reactor. It was a reactor that was built many years ago, possibly for the intention of producing plutonium. And plutonium is one of the key resources that are used in producing different types of nuclear weapons. For example, during the June 2025 war, it was targeted. The dome of the building was penetrated and likely the reactor was destroyed. It wasn't operating at the time, so there's no release of radiation, et cetera. Israel at the time also attacked the heavy water plant. They damaged one of the last stages in the heavy water production. Heavy water is a very important chemical compound that is necessary to operate heavy water reactors. It's also a source of neutrons in a nuclear weapon. So destroying this facility is incredibly important to creating bottlenecks in Iran's future ability to create nuclear weapons. What we saw at Ardicon is also similar. Ardicon was used to convert natural uranium into yellow cake. And yellow cake is what's converted into uranium hexafluoride, which is ultimately enriched to higher and higher levels and possibly weapon grade levels. So we're seeing Israel eliminate certain stages and steps and that are vital for Iran to be able to continue its enrichment program and wider nuclear program.
Are there any key red lines the international community is watching when it comes to this?
Necessarily, it would be the enrichment up to 90%. That has been stated to be a massive red line that if Iran touches that, in the past, obviously, many past presidents have stated that that would trigger strikes. But the key here is that Iran hasn't reached that yet. But what Iran has been doing, they've been accumulating very large quantities of 60% highly enriched uranium over the last several years. They're the only country in the world that does that doesn't have a nuclear weapon. There's no civilian application for that type of enrichment. So there's no justification whatsoever.
Spencer, can the U.S. and Israel destroy Iran's nuclear facilities without endangering bystanders through the release of radioactive material?
Yeah, certainly. You wouldn't want to target something like a Bushehr-style nuclear reactor. That would have very large consequences. You wouldn't want to hit the actual reactor itself. But the other facilities, such as Fordow, Natanz, Esfahan, etc., those are relatively isolated facilities. They're a good distance away from populations, and the actual risk of dispersion on a wide level is relatively low. It would be very isolated to the facilities themselves.
Do the attacks in recent days on these facilities, do they call into question the official U.S. assessment or of the damage assessment of the June 2025 strikes? Because I think a lot of folks thought, okay, well, based on the rhetoric and what we heard from the president at the time, the nuclear program in Iran was set back quite a bit.
Yeah. So, we had some issues with that initial assessment. I think you're referring to the assessment that said it was only set back a few months. We had some issues with that. Our analysis stated that the program was severely set back. The June 2025 war effectively destroyed Iranian's enrichment program, and enrichment is a bottleneck in the ability to produce a nuclear weapon. If you cannot get to 90% weapon grade material, it's very hard to build any sort of usable nuclear weapon. 60% highly enriched uranium, technically, theoretically, can be used to build a nuclear weapon, but it's not practical. It's very hard to deliver. It'd be a very large device. But what Iran had plans to do during its Ahmad plan, and that was ended in 2003 explicitly and continued in a more covert form, was to build missile deliverable miniaturized warheads that would fit on a Shahab-3 ballistic missile. And so that's a very different thing. Our assessment was that their program was severely set back and it would take years for Iran to recover what they actually lost. But that doesn't mean that Iran doesn't have options. So after the war, there's a few outstanding elements that were left over. For example, obviously, everyone's talking about the highly enriched uranium. Half of it, the 220 kilograms of the 60%, is likely in the tunnel complex at Esfahan. There's a lot of talk and chatter about that right now. Iran also produced a number of advanced centrifuges that they built but likely never deployed. So there's questions about where is that, and then the wider state of what's the actual accounting of all this. The IAEA has not been allowed to conduct inspections on the ground. So there's significant questions here, and it leaves Iran options for the future.
Spencer, gonna have to leave it there. Have a great weekend. We got to get you back on the program soon. Spencer Faragasso, Senior Fellow at the Institute for Science and International Security. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, Nasdaq 100 index, all in the red. Nasdaq 100 right now in correction territory, and U.S. stocks trading very close to session lows. On the S&P, we're below 6,400, 63.85 right now, down 1.4% for the S&P 500 index, a drop of 91 points. The Dow down 687, a decline there of 1.5%. The Nasdaq Composite Index down 406 now, down 1.9%. The Nasdaq 100 Index down 1.7%. The 10-year at 4.42%, with the 2-year 3.90%. Gold up $130 the ounce. Spot gold $45.06 the ounce, up 3%. West Texas Intermediate crude closing in on $100 a barrel again, 99.81 right now. WTI surging 5.6%. Barrel of Brent above 112. Brent crude right now up by 4.3%. Citigroup shares down 4%. Citi's top executives are weighing buying another bank, a move long considered inconceivable as the firm wraps up years of work to address regulators' criticisms. Again, recapping, stocks move higher. We've got the Nasdaq 100 index in correction territory. Oil is surging. West Texas Intermediate crude $99.75 a barrel now, up by 5.7%. I'm Charlie Pellet. Tim and Isabel, that is a Bloomberg Business Flash.
Hey, Charlie, thanks for that update. Some of those superlatives worth repeating. The S&P 500 on track for its longest streak of weekly losses going back to 2022. The Nasdaq 100 falling into correction territory. The yield on the 10-year climbing toward its highest since July. The war in the Middle East driving up gasoline prices. Data showed today that U.S. consumer sentiment slid to a 3-month low in March, and year-ahead inflation expectations jumped. I want to bring in Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. She joins us from New York. Kathy, welcome. I want to start with the war. You write that it is inflationary. I think we're all seeing that happen right now, at least when it comes to oil prices and the way that oil flows through to the rest of the economy. What's the bond market telling us about how inflationary it will be ultimately?
Yeah, what we've seen is the way we look at it, Tim, is through the TIPS break-even rates. Now, that isn't necessarily the best measure, but it is one way the bond market tells us what it's expecting. And those break-even rates have moved up, particularly for shorter-term TIPS. They're, pushing 5% or so for 1 year. So it's implying that the market is expecting an inflation rate, at least on a short-term basis, to move all the way up to as high as 5%. The longer-term break-evens are still pretty well behaved, maybe around 2.5%, but they have come up. So what we've seen is the expectations about inflation move higher across all tenors, but particularly across the short-term tenors. And you can look at other measurements in terms of expectations. I think the bond market, though, is really speaking loudly right now that the big fear is inflation hitting us due to the war.
And in private markets, spreads are widening. How much of that is growth versus just really the stress in the private credit space?
Yeah, there's a combination of things going on here. So kind of coming into this, we've seen spreads were really compressed, really tight. So anything that didn't work out perfectly was probably bound to cause them to widen. I think now between the woes in the private credit area and the expectation that we're going to see some weakness in earnings amongst various companies that might be caught in this, in the after effects of the war or the downside of what the war may do, starting to widen those credit spreads. It's also probably just a general risk aversion taking place as investors just pull back. Credit spreads tend to be correlated somewhat with equities. We're seeing equities come down. I think it's just a risk aversion taking place.
Why, Kathy, do you think that treasuries are not being viewed as a safe haven asset right now?
Yeah, it's got to be somewhat disappointing, I think, to a lot of analysts who thought perhaps we'd see a run into treasuries. But I think the primary mechanism that we're dealing with here is the inflation pressure that was already building up coming into the war from, the fiscal stimulus from the One Big Beautiful Bill and the fact that inflation's been above target, the Fed's target for 5 years now. I think that there's the market's not as comfortable with treasuries as a risk off right now because of those factors. And the Fed is not indicating an aggressive rate cutting cycle because it's not yet a financial market risk. But I wouldn't rule it out down the road if financial conditions tighten enough, if there's enough worries about economic growth down the road that we could see treasuries rally. I do think we're getting to valuations that discount a lot of negative news, but in terms of flight to safety, the dollar's gone up, but we haven't seen a whole lot else in terms of the treasury market.
So talk a little bit, if you could, Kathy, about what it would take for you to see investors flock to treasuries as a safe haven. Like, what financial conditions would need to tighten? What would need to change?
Well, I think it could go one of a couple ways. So on the one hand, if we had a severe enough sell-off in the stock market or in risk assets, where we started to see the potential for the Federal Reserve to come in and provide some sort of support, then I think you'd start to see treasuries rally. And again, we may not be too far from that, because if conditions tighten enough, then the economy is going to take a hit, and that would pull the Fed in. A second way that it could occur, though, is that, we do start to see the war and, these tightening conditions really, really depress expectations for economic growth. And then we'd start to see people move out on the yield curve, looking for something that would benefit from slower growth. But again, we're just not there yet.
We're seeing a bear flattening in the yield curve. What should investors take away from that signal?
Yeah, and again, this is kind of a not great signal for Treasury investors right now, the bear flattening. We've been in a steepening, which was, I think, generally, we have been talking about the steepening for about a year or so, as the expectations were for the Fed to cut rates, but inflation to remain sticky. And that was keeping the curve steepening. You add in the rising debt levels, deficits, financing, that's happened. Now we get a little bit of a bear flattening now. I think that's more driven by all the focus on the short end and seeing those yields move up to compensate for inflation expectations.
So the Fed and where the Fed goes from here. There are a lot of questions about what the actual next move at the Federal Reserve will be, higher or lower. What do you think it'll be?
Well, I think they'll try to stay on hold as long as possible. So I think they're trying to navigate this by doing very little and saying, well, we're positioned okay for now. This thing could go one way or another. We don't want to make a mistake. And again, if the war continues and we continue to see upward pressure on prices, oil prices in particular, then barring a big decline in the economy or rise in unemployment, the Fed may actually have to pivot towards hiking rates. I don't think that's the most likely outcome, but it is now on the agenda, I would say, because of the inflation pressure and the rise in inflation expectations. So a lot's going to depend on the labor market, but I would say no change in policy for the rest of this year, barring a big surprise. And maybe we're building in the potential for a rate hike somewhere, late in the year if things continue. But it's such a highly volatile environment, both from a policy perspective and a market perspective. I think for the Fed to try to make a call now, let alone us spectators, is really difficult.
It does seem like the Fed is relatively calm about long-term inflation. Do you think that the market, though, is underestimating that risk?
Yeah, I think the Fed Chair Powell has frequently pointed to those break-evens in the TIPS market as an indication that inflation expectations are well anchored. And I take a little bit of issue with that, because as you go out in the TIPS market, the liquidity isn't great. And it's easy to latch on to an indicator that, maybe provides some confirmation bias for you. There has been a divergence if we look at survey-based, say, University of Michigan survey inflation expectations. Seen short run, inflation expectations rise very sharply, and then the longer run rise, but not as sharply. that may be a better reflection right now of where inflation expectations are than the break-even rates. Again, the Fed is taking comfort in those break-evens. I would say I would look to the survey-based right now, because the longer inflation stays up and goes higher, the more those expectations get built in, and the longer it's going to take to unwind them. So I think the Fed may be latching onto something that may not be as strong an indicator as they would like.
Hey, Kathy, before we let you go, I just want to take a moment to recognize the incredible career that you've had. You're stepping down, or retiring, I should say, from Charles Schwab and from the industry at the end of this month. And we're gonna talk a little bit about that. But before we do, this moment in the context of your career, it's a really complicated one. And you're sort of, I think it's fair to say, at least when it comes to the news cycle, you're going out on top. But how do you view this moment in the context of your career?
It's one of the most complicated situations I've experienced, and I've been around a while, so I've experienced a lot. All the way from the commodity markets of the late 70s, early 80s, and that was crazy. The flash crashes, the big crashes in markets, the Asian currency crisis. I mean, you name it. Certainly the great financial crisis. I've seen a lot. This is not as severe as some of them, because I think the economy was in decent shape coming into this. But I think from a policy-driven perspective, it's one of the most complicated, because it really wasn't signaled very much in advance that we were doing this. We were at a kind of pivot point in terms of trying to get inflation down. The global economy is feeling a lot of inflation pressure and was coming into this. So we've had a combination of policy issues that are hard to unwind, along with market issues that are hard to unwind. And I would say this is one of the trickier that I've seen in my career.
Well, Kathy, we are so grateful for all the time that you took with us to join us here on Bloomberg Businessweek. You've had an incredible career, not just at Charles Schwab, but at Morgan Stanley, at Citigroup, at Prudential Securities, and more. And we're grateful for you spending so much time with us. Carol wishes she was here. I promised we would say goodbye to you for her, and she sends her best. So don't be a stranger. Enjoy retirement. Enjoy hanging out with those grandchildren. And we will see you, hopefully, sometime soon. Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. Kathy, thank you so much. All right, well, let's take a look at what's going on with markets right now. We talked a lot about fixed income just now, but don't forget the equity market under pressure, down 1.5% on the S&P 500. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, Nasdaq very much in the red. Nasdaq 100 index now in correction territory, and the S&P 500 index is on track for its fifth week of declines. The S&P down 95 right now at 6381, falling below 6400 this Friday. The S&P is down 1.5%. Dow Industrials down 717. The Dow is down 1.6%, and a 2% drop now for Nasdaq. The Nasdaq Composite Index is down 418 points. Nasdaq 100 in correction territory with a VIX now closing in on 31. The 10-year 4.43%, the 2-year 3.91%. Oil surging. West Texas Intermediate crude up 5.1%, up $4.79 a barrel, $99.31 right now on WTI. A barrel of Brent over 112.23, up right now by 3.9%. And gold up 3%, $45.18 the ounce on the precious metal. Microsoft stock on track for its worst quarterly performance since the global financial crisis due to concerns about investments in AI infrastructure and potential disruption from AI startups. Today we're looking at shares of Microsoft, and they are down now by 2%. Recapping, West Texas Intermediate crude 99.25 a barrel, up 5.1%. The Nasdaq 100 index in correction territory. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. The S&P 500 down by about 1.5%, bouncing off its worst levels of the day, but hovering close to those lows. The Dow down 1.5%, the Nasdaq Composite down 1.9%. Charlie talking about the Nasdaq 100 being in correction territory, down 10% from recent highs, down right now by 1.7%. We do also have a redhead crossing the Bloomberg terminal. President Trump signs a memo directing use of funds to pay TSA staff. We'll bring you additional information about that and also reporting around whether or not that helps with those delays in those TSA lines at airports in the coming future. I want to continue our coverage of the latest out of the Middle East and the war in Iran. It's affecting markets with stocks lower, oil higher, a drop in treasury stalled. Suffice it to say, there's a lot for global business leaders to digest right now. That's where Angel Saz comes in. He's professor and director of EsadeGeo. It's the Center for Global Economy and Geopolitics at ESADE, the business school in Spain. Also with us, Dimitra Kessenides. She's Bloomberg Businessweek senior editor. She leads Businessweek's coverage of business schools. Angel, good to have you on the program. You are a business school professor, but you're also an expert in geopolitics, international business. The macroeconomic backdrop today, higher oil prices, barriers to free trade, increasingly countries looking inward. You teach a global community of business leaders who then become leaders who go out in this world. How are you looking at the backdrop today in the context of your research?
Great, thanks. Thanks for having me. It's a pleasure to be here. So I think there are two ways we're looking at it. So one is to understand where we're coming from and where we are. And I think one of the difficulties of today for business leaders is that we are stuck with global value chains that are hereditary from those decades of open markets. And we're now in an environment which is not that open any longer. So you have many more vulnerabilities and risks around you. The second one is more short term. So what do you do? And I think there you can play with different scenarios. And I think what we were talking about in classrooms and with executives around in ESADE is to see how they can think about how long we're going to have this crisis. What are the different options? And basically, I think it comes down to whether Hormuz is open or not, and how much long it can be closed, and then try to make sure what are the transmissions that can affect the transmission channels that can affect business strategy. And of course, there's oil prices, as you were saying. There's inflation. There might be effects on upstream in your value chain with critical inputs. It can be downstream with your exposure to markets. I think many business schools, for example, were open and doing business in the Middle East, and now we are on a standby. And so that's and then finally, I think what we are seeing is this new economic security paradigm in its full strength, which is what we're seeing is governments intervening markets to guarantee their energy security. Unfortunately, not in a global collective way, but at national level. So all these different companies are seeing how governments are interfering.
Well, let's just hit on that for a second, because oil prices, it's visceral. It's something that a lot of Americans see when they drive to work. It's not something Americans are used to. Other parts of the world, high gas prices are just that's the cost of doing business. The government intervention, it can only be successful to a certain extent. Countries have strategic petroleum reserves or variations of that. You could subsidize, like we've seen in Japan, a little bit. What works?
So, I think what we have seen in the past is that what usually works is when we have a collective solution to a global problem. And in fact, that's why the International Energy Agency was set up back in the first oil shock, because countries had to coordinate, in particular oil-consuming countries, to coordinate collectively to make sure that you don't start a war, an economic war among countries by all of them starting to impose export controls and controls on exporting gas and their derivatives. So I think what we know is we need a collective action. Otherwise, we're going to go into a bigger thy neighbor sort of policies, and this can be a sliding slope.
And you mentioned the government intervention. It's been increasing, even in democratic countries, even in countries where you won't expect. I'm not going to name some. How do you think, is there a threshold there? And I know it can be hard to quantify, but if you use the case study of what's happening today to teach your students, what do you tell them?
Well, I tell them that the world globalized because countries decided that they wanted to globalize and open markets, and they wanted to respect markets. And that's where we were coming from. That's over. Today we have countries that are not that interested in keeping borders open. And secondly, they have given up on the principle of the sanctity of markets, for good or for bad. And so what is happening, and even before this very severe crisis, we already had many countries coming up with two types of policies. One is economic security policies, where you start to see how they are affecting markets, companies to check their value chains, make sure they don't get kicked up with certain suppliers, which means they're really going down into the detail of how corporations operate. And the second one has been the way they go after industrial policy. So industrial policy is back in vogue.
Yeah, it is. Dimitra, come on in here. I see you nodding.
Yeah, I was just going to say, I think that's a super interesting part of your research and the work you've done is what we've seen with the way that companies are going after this industrial policy and taking on, for example, lobbying more directly on their own rather than through associations or the way that we've traditionally thought about lobbying. And that's also another piece of this and something that Angel has spent a lot of time on.
Angel, is that specific to the United States or specific countries? Because when I hear that, I think, okay, lit bouton of Intel going to the White House, and then that Intel, over the summer, and then the big Intel stake that the U.S. took, and critical mining, critical minerals, the ties that the Trump administration has with the business community. Is this happening outside the U.S. too?
Oh, yeah. I think it's happening across the world. I think it's always happened. For example, in China, when China came up with Made in China 2025 back in 2015, we were all scandalized. Today, we're all doing our own industrial policy. So I think that's not only the U.S. The U.S. is, of course, very visible, had been a leader of the free market, had been a leader of the West in that sense. So when you see this in the U.S., it's really, really surprising to see certain policies. No, and then the other thing is that the more industrial policy we are seeing, the more companies need to then get involved to design those industrial policies, because industrial policy essentially means government going in and trying to affect and design markets in detail.
It's fascinating stuff, Dimitra. I want to end with you because you oversee coverage of Business Week of business schools for Bloomberg Businessweek, and business schools in recent years have become so international. Recent decades, I should say. What is it like now as countries increasingly turn inward?
I mean, we're seeing that sort of trend towards the top U.S. programs are still the ones that are the most in demand and the most desired globally. But I think that anecdotally and even in terms of the data that we're seeing coming out of certain bodies, there's a lot more happening and movement towards international programs. Not just because of what's playing out geopolitically and maybe the type of programs and institutes you'll find in places like ESADE, but because of the sort of the perception that we are not really the most welcoming place for some of those students and what they're interested in pursuing right now.
Dimitra Kessenides, Bloomberg Businessweek senior editor, Angel Saz, professor and director at EsadeGeo, Center for Global Economy and Geopolitics.